How did Black Monday 1987 crash so suddenly? Imagine waking up to a world where stock prices are plummeting faster than anyone expected. That is exactly what happened on Black Monday in 1987. The crash happened in a flash, catching everyone off guard. It was not just a normal market dip. It was a rapid, cascading collapse that shook the financial world. To understand why it happened so suddenly, we need to look at what was going on before that day. The stock market had been soaring, with the Dow Jones Industrial Average climbing about 44% in just 7 months. Investors started to worry that stocks were overvalued and due for a correction. When selling began, it triggered a chain reaction. One big reason for the quick fall was the use of computer trading programs. These were new back then and included automatic stop-loss orders. These orders were set to sell stocks once prices dropped by a certain amount. When the market started falling, these programs kicked in and sold huge amounts of stocks automatically. This made prices fall even faster. Another factor was portfolio insurance. This strategy was used by big investors to protect their holdings. It involved short-selling futures contracts on stock indexes like the Standard & Poor's 500. When stock prices dropped, these investors had to sell more futures contracts to hedge their positions. This added more downward pressure on the market. Economic worries also played a role. News about the United States trade deficit and a falling dollar made investors nervous. The week before the crash, markets had already been volatile. There was also a phenomenon called triple witching, when options and futures contracts all expired at the same time, adding to market uncertainty. International markets started to fall before the United States opened, creating a global sense of panic. The suddenness was also caused by a lack of buyers. As prices dropped, traders rushed to sell, but there were not enough buyers to match the sell orders. This created a liquidity crisis, making prices fall even faster. In the end, the crash was a perfect storm. Overvalued markets, automated trading, portfolio insurance, economic fears, and global panic all came together. These factors caused a rapid, worldwide collapse in stock prices, making Black Monday one of the most dramatic market crashes in history.